Here we go. We have a daily chart. It's an update. It's intraday. It's 8:13 a.m. Pacific Standard Time. It's a daily chart, not a weekly chart. And what MMTs are learning here with me now is what is holding the name on a daily chart is that 10-day simple moving average is acting. Here's the markup. Here's the oversold. Here's yesterday's markup. In the shorter term, that blue line is called a 10-day simple moving average. You have to have a buy program that as you go through it, that the short seller will cover as we move up above these daily 10-day simple, 20-day simple, red line up here, moving averages now. And this is just the big markup, and it's consolidating on low volume. So basically, after a $25 run yesterday with a big gap, remember, it was not a buy-side market yesterday. It was a gap open to the low end, to the high end. So the majority of the price movement was done in a pre-market 2011 pre-market gap. And yes, after that big markup and this little bit of pullback at the first pass of its 10-day simple movement average is what the public is going to look at. And you're going to apply your platform, which is the MMT trading application, here is going to reflect that high movement that we went straight up to that 590 area. We hit that on a standard chart between what the public looks at is that 10-day moving average, and they were, low volume, very low volume pullbacks, and we're all the way back down here on our application of where markets get made. And you had the opening bell at the bottom to the run to the high up here at 589, and you come down and they're going to lever back up the tape. And at some point, the 10 and 20 3-minute moving minute period, these are minute period moving averages, will float around, and then you're going to run back up. So the dilemma will be is when we take out the daily moving averages in a very short term. Our application, though, will lead you in where the turn is going to be and how the overall move from the big celebration gap in the broader markets yesterday occurred is where is the strength and how do we take out that current resistance level. Okay, and as far as these go, they marked them $10. We bought and sold into it. We have a little position on one contract here. We will continue to hold the contract on a 1217 based on the fact that we would be buyers at 670. And once again, I will be very happy to pull up a 60-minute chart here, and what I'm going to actually do is I'm going to go to Google and I'm going to go to my December $600 call. That's what we're trading, and I'm going to throw it in here. And you can see here where the so let's take a look at the markdown and what Google has to do. The markdown was way up here on the $600 call for December. They were inflated. They got up here. They marked them down to here. We did not have a chance to make it. That was yesterday's low, right around where we're going to buy some more. That was the low of yesterday's gap. This is the high right up here at $10. They're still deflated. The call, the equity platform is that we would be a buyer down here at the low end of the gap and add more call contracts to that 600. We're still marked down. We're not nearly as wholesale as we were because there was a markup and you couldn't get that low, but you got in here. And we will add some more in the overall structure of the contract. For overnight accounts, you would have to take in consideration your overnight buying power. Intraday, you would want to add at the lower level and I'll put the bid out just the way that the name is acting right now. I'm going to cancel all here at $6.70, and I'll drop your bid to $6.50 on 2 contracts. A limit in on 2 here at 6.5. That's the gap up. This is the fade back. We got the equity side of the name. We got a 10-day simple moving average. This is a 3-minute chart. And if we hold the bottoms here in our platform, and we can base and not and actually look for that upside move all the way back up here, at some point it will happen. Right now the overall liquidity is very low. Once again, there is the chart, there is the turn. It'll take some time on low volume. How low is the volume? Right here, 750,000 shares. And what's that going to do? The lower the equity volume, the more that it affects the short-term premium. The pricing premium authority that we have is that on the lower volume print, they have a tendency of lowering bids. That's where you're going to want to buy during that mechanical phase that they do in this call side of the 600. And having those bids out there at 6.5 times 2 is totally appropriate in this markdown $600 call at the very moment when the retail prices were up in here and we're buying down in here. And it's the second day. That's the markup, and you come in and you start making markets, and you see how that they're still marked down in price, because they are. And once again, December 12/17 $600 call, and how to scale the range using the equity volume and taking advantage of the fact that the put side is up $1.10 from the low of the 590 put. That's the 10-day simple moving average. Anytime that you run up toward that simple 10-day moving average on the daily chart that we showed you, then you would be transacting the 590 put at that resistance level, because you're going to get a small gain. You got a low of 7 and you got a 87 by 9. The high was 960. And remember, they had marked these things down just like they marked down the calls all the way down here. Well, they did the same thing with the put option. So if I go over here to Google and I go in there and I pull up another, here is the $600 put for 12/17. It's in the money. And you can see that they marked these puts from $40 the other day. They took 100% out of that. Now, they marked down both sides of the market. This is that $600 put. And the thing about it is, that $600 put, when Google breaks above that 10-day simple moving average, that means that this put, the $600 put, you'd be looking at it breaking down here, where it would start to get deflated at 10. Not 22. So that's the put side here. The 590 put for December is also been marked down, and it was marked way up here. It was inflated as all get out. And you can see that these were $22. These need to be marked down over here. So when we break resistance levels looking forward on a low volume pullback, we look to add, but then we're going to look for the value in the December contract for that put side got marked up today from yesterday's lows. It has a little markup here. However, they're not totally inflated because they were marked down on 11/28 yesterday. And this is the bottom of that one. Now, when you're looking at a short-term trade on a 590 put MMTs, that's going to be this one here, and it's a weekly. And you can see clearly here the weekly, which is only a weekly, it was marked down from way up here. The highs yesterday were $16, and the put side got marked down on the very same 60-minute chart. We got down to $7 over here. This is 60-minute. Today's low was 690 today. I'm showing a 690 low here, and I'm showing a high. If we're getting the right data, I show a high print of $10 over here, okay, and a low of 770. Originally we had a 770, we took it to 670 down to 650, limit in, based on the fact that the 590 put weekly, when you came up and hit that, is how this will drop down in value. Once it does, it's a weekly, but it can be traded when we do move higher in Google. We're going to look for this put to contract in value, come down in the bid, lose its value, and that this value over here that is being marked down $2 from the previous day's close, called PC, previous day's close, is that we get the lower end of the bid at 6.5, and that we will monitor that entry for a 1217 hold, but constantly looking at the value being marked down here, and the $1.60 markup in the put, 590, and $1.80 on the $600 call marked down, about the same almost. That's the ratio between understanding how to use the short-term weekly reversal and how we're going to buy below the market. Once we do hit the final support level, there's 435 calls, and the put side for the weekly's got 370, which was, most of those were traded on the opening bell, and they're up $2. Not much of a premium adjustment from the big markdown on this side of the market. So we're clearly understanding our position, and we're clearly understanding that the daily equity outside of the call and puts, that's this 10-day simple moving average. That's their current resistance. When we break above it, the 20-day moving average is at 594, everybody. So the 20-day simple moving average at 594, that's the red line. The 10-day simple moving average, where it's having a problem today, is 589.09 right now, and it changes and it varies. We are working good in the percent daily DS. We went from 18 to 2790 to 32. So we're definitely ascending in that. The current CCI is minus 38. It's not in positive territory on a daily. That's what some of the people use in the fundamental and technical analysis world. Basically, the low volume selling, the lower end of support level is going to be that 40-day simple moving average. That would be an ultimate test at 579.67. That's the 40-day simple moving average. I will conclude the update here and the update here relative to daily 10-day simple moving average based on the public buy and sell model that is used, and how my MMTs will get this lower bid of this low volume markdown in the equity and come out a big player.